Hello, hello. We are here with Charlie Miller. I feel like we need a jingle.
We'll have to come up with a good one.
Like it's the Charlie and Mark.
On that. Yeah, exactly.
Something like that.
I got the guitar. No.
Hi, Charlie. Charlie, let's hear let's hear a little bit about Charlie so that we know who we're talking to. Don't pay attention to the lady next door is cleaning her office. Today was the day for her to clean the office, apparently.
All right, sir. So yeah, I'll give you a little bit of background on myself and experience in the industry. So number one, thank you for having me on. It's always nice to get out and then market yourself and answer some questions. So that's what we're here for. So I was actually started the industry. I guess this is already my 7th year. Got started and kicked off as an intern in college, and it was really cool. Had the opportunity to work on the processing, underwriting, closing, kind of the operations end of things, and see how that works. And then after that, my 2nd year as an intern, I was actually in sales. And so from there, I was in 2010. I've been doing loans since. I was with Wells Fargo for about 5 years, and then went to a privately owned company called Movement Mortgage, which was pretty cool. Got to see both sides, big bank mentality along with a privately owned company and a direct lender. With my current company for the last 6-7 months now. So everything's going great. So that's a little bit about me. Born and raised over in Maryland, do business in DC, Maryland, and Virginia. So local and here to help.
You're local and you're not new. That's what it sounded like.
Exactly. So we've had a lot of great success, a lot of great opportunity. We've partnered with really good people, such as yourself, and had the opportunity to help a lot of people. So it's been exciting. What we do is not always the necessarily the easiest or the most fun, but it's dynamic. And at the end of the day, when we get to help people, it's a lot of fun.
That's what it's all about. That's what we do this for. All right, let's jump.
So let's get some questions going.
All right. So the first thing I want to talk about is what everybody seems to want to know. And when is the perfect time for a potential home buyer to reach out to start the pre-approval process?
Yeah, that's a great question. And that's one of the ones that we get a lot. The answer to that is as soon as possible. So as early in the process as possible. The last thing that you want to do is put yourself in a position to not be able to win an offer, or better yet, to go under contract and then just find out weeks down the line you can't qualify for the financing. So our goal, we exist upfront to go over products, programs, what goes into qualifying for a mortgage, the overall process, and the costs involved, so you understand a full picture and a full scope of what to expect moving forward. So to answer your question, ASAP. Before you spend a lot of time, the last thing we want you to do is go out, find a beautiful home that you fall in love with, and then all of a sudden,
can't spend that much. That's always the worst.
Exactly. So it's a waste of your time, and the big picture is when I bought my first home, I remember going to the house and saying, "This is it. I can picture myself in this place," and I would have been heartbroken, And so our goal is to make sure that does not happen to somebody else.
Sounds good. All right. Next one.
Yes, sir.
Will pulling my credit from a few different banks or mortgage brokers damage my credit? Is there a time frame? What's the rule of that? Is there a rule?
Yeah, there is. No, that's a really good question, and that's a really common question. We live in a very, say, affluent or intellectual clientele. It's our main client base, and so you have people that are very in the know. So there's 2 different types of credit pools. There's what's called a hard pull and a soft pull. A soft pull is something like you going out and pulling your credit. It's a proprietary score that you're going to get from one of the bureaus. When we pull your credit, it's called a hard pull. And a hard pull can impact your scores. It's a hard inquiry. We get everything on your history and your situation. And it's something that you don't want to do often, because hard inquiries can start to impact your scores. We tell people, depending on the bureau, anywhere between 4 and 7 points or so, a hard inquiry can hit your credit scores. So it's not something you want to do regularly and or every month. To answer your question, when it comes to multiple lenders, it's always good to get a couple opinions. And we understand that people are going to shop and get a couple different opinions. And we respect and appreciate that. And often we recommend that. If you're going to get a couple opinions, there's a couple week time frame that you want to have your credit pulled. Typically, the goal is to have it pulled within 2 weeks, 14 days. Some people say 30 days, but just to keep on the safe side, we always recommend having your credit pulled multiple times if you're going to do it within 14 days.
Okay, that's good to know. Yeah, thanks for that.
Yeah, no, and does that answer your question?
Yeah, it does. Let's talk a little bit about the credit score now.
Yeah.
Is there a minimum score that someone needs to qualify for a home loan? Is that different across other, different kinds of loans?
Yeah. So number one, thank you for bringing that up. So a couple things. First off, credit does have a big impact on qualifying. It's the first thing that mortgage companies are going to look at, right? So there's you're looking at credit. Little secret, there's 8, for the most part, all lenders are going to use what's called a FICO score. There's 8 different algorithms that FICO uses to compute your credit scores and your credit history. Depending on why your credit's being pulled and who's pulling your credit will determine what those scores end up being. So typically, the mortgage pull is one of the most strict ones, we could say. So to answer your question, there is a minimum credit score, and it depends on the program. So you want just a bottom line, we always recommend at least a 620 credit score. That'll allow you to have a lot of flexibility on conventional, or be able to go with conventional financing, government financing, FHA, VA financing. The better your credit scores, the easier it's going to be to qualify, and the easier and the better your interest rate, mortgage insurance, and things like that. Just opens up options. So yes, credit is a huge thing we look at. There are different credit scores. You can go down often to even under 600 credit scores with government loans, VA loans, FHA loans. But if you're doing that, usually that's when you need some compensating factors. It's also going to impact your ability to qualify and interest rates. So something just to be aware of when you are looking at this stuff, that you need to make sure we look at that right up front to make sure we can advise and guide you the next steps associated with that.
Good to know. So
580, 620, is really the ideal situation at least.
No.
We go up. So
it'd be nice if you had a 680 or higher, probably, to get
exactly. If you have a 680 or better, there's some pretty cool loan programs that exist out there, and there's some good stuff that allows us to really help save you money when it comes to interest rates and mortgage insurance, low down payment, and all of that stuff.
Well, you mentioned government loans in the conversation, so I would imagine that next week we might have a little slowdown if you're already under contract.
So we're going to find out. That's a really hot topic right now, especially with everything in the news and the government shutdown. I guess it's midnight tonight, right? So what is, if you're in the process or in the shopping, especially under contract, contact your loan officer. You want to make sure that you take this up front and be proactive as opposed to reactive. But yeah, so hopefully they'll get something worked out in the Senate today. I think the House passed something last night, so we'll see. But who knows? I'm not very optimistic.
Neither are we. How about down payment? Is what programs allow me to put the least amount down? What's out there right now? What do I need to do?
So by far, my favorite loan program is for veterans VA financing. If you're not a veteran, it's not really easy. There's no loan program that exists that allow you to necessarily get or obtain 100% financing. So VA loans, again, you do 100%. You have to obtain your eligibility, and we work on getting a COE or certificate of eligibility from the VA with you. No mortgage insurance, all that stuff. But again, if you're not a veteran, there are programs out there that allow you to get money for down payment. And also, when you're looking at down payment, a couple things. Other main loan program, FHA, for the Federal Housing Administration. With that product, you're going to have to put at least 3.5% down. So the nice thing with down payment, that 3.5%, the bad thing is no one associated or involved in the transaction can help you with that. They can't help you with that. And that's something that we may jump into today or may not. But when it comes to down payment, it's something that you have to come up with. Whether it be savings, retirement against your retirement, or liquidity against your retirement, whether it be obtaining a gift from a family member. In some certain kids situations, you can get it, obtain gifts from friends as well, with a well-documented interest in you. Or down payment assistance programs. So down payment assistance programs are a great means to obtain money for down payment. The downside is that you have to prepare. You have to qualify with credit. They are going to have income you're going to have to take a first-time home buyer class or a home buyer class. So there are a couple extra steps associated with that you want to connect with us on. But one of my other favorite loan programs, real quick, I know we're running tight on time, is Home Ready or Home Possible, Fannie Mae and Freddie Mac. Allows you to put as little as 3% down with conventional financing and obtain a reduced mortgage insurance. Again, preferable that your credit be 680, and you do have to meet income restrictions, but you'd be surprised with what those are. In most areas, or a lot of areas around here, it's over 110,000. So it opens up the low down payment programs for first-time home buyers, and you don't have to be a first-time home buyer to take advantage of that product either.
All right. I think that this is a good time to take a question. We have a question from Deetra Allen. She says, how do student loans, lots of students, play into getting a loan for a home?
So that's a huge question, especially around here. So student loans, they have a big impact on qualifying. Obviously, around here it's expensive to go to school. We understand and understand that people experience that and face that. So a couple things. Depends if they're deferred or forbearance. So if they are not, then obviously we'll just use the monthly payment associated with the student loan. Oftentimes there are income-based payments that we can take a look at and use to qualify as well. But that is one huge topic. Typically, if it is in deferment and it's not deferred for at least the next 12 months, we do have to compute and use some portion of that to qualify for a loan. Usually it's around 1% of the outstanding balance. So unfortunately, that has a big impact on qualifying. So we do have some programs to help with that. We have, and depending on what the situation is, we do have a doctor loan program that allows us to, limit that impact on qualifying, depending on if that's something that you're looking for or is based on your situation, really, when it comes to that. But student loans, yes, if you want a strong idea, they are going to have a big impact on your qualifying. We do have to include them in your debts when compared to your income. And you want to make sure that you speak with someone like us up front so that we can tell you what to expect depending on what loan program you're looking at.
Awesome. Good to know. Thanks, Deetra, for asking the question. Let's see.
Yes.
What do we have next? Oh, here's a good one. Mistakes buyers make. What mistakes do buyers make most often during the loan process?
So when you work with a good realtor like Mark and a good loan officer, you pretty much, the whole idea is to set the proper expectation and to do everything to avoid big mistakes up front. So a lot of big mistakes buyers do is credit. Mostly a lot of times that'll come down to it. So credit, number one. You don't want to, once you go or obtain pre-approval, you don't want your situation to change a lot. That pre-approval is based on that point in time. And if your credit changes, your income, your assets change, things of that nature, and that can have a big impact on your qualifying. So don't open or close any debt. Closing credit trade lines or open trade lines can impact your scores. Opening new ones can impact your scores and also increase that debt to income ratio. So don't open in any new trade lines or credit cards. Don't go purchase anything. Don't finance a car or buy furniture for the property. People do that. The challenge up front is we don't see that until we are notified that your credit's been pulled, and then we dig into that and find out that you have more debt and it can impact you being able to qualify. So don't do anything with your credit. Second, don't move a lot of money around. When you use or when you move a ton of money around, it has it's not that we can't use the funds for transactions, they have to be sourced. So it can just make it a little bit more stressful, a little bit more burdensome from a documentation standpoint if you constantly are having cash deposits between your accounts. Lenders have to verify and source where the money is coming from for down payment and closing costs. And if there's a lot of cash deposits, we have to source those. If we can't source them, we can't use them. So very big thing there is if you move a lot of money around, it can have a big impact on documentation and slow down the process.
Charlie, that led right into I have a funny man friend that decided to can you use gambling winnings as down payments on a home? Asking for a friend.
Do you report them on your tax returns, and is it something that is very common for your situation? And it may be. Maybe you are a professional gambler. Report all of that income, and then we can certainly take a look at.
Send this over your taxes, Jeremy.
Oh man.
Let's see what we have next. I think we're just about through it. What's your favorite product right now?
Right now, again, VA is by far my favorite. We get to help our veterans, and it's just a lot of fun. But in all reality, I have to say probably that home ready product that I mentioned previously. You can put as little down with conventional financing. Often, if your credit is over 680, you can get a better interest rate and a reduced mortgage insurance. The mortgage insurance is calculated at the same with 10% down, but you're only putting 3% down. So it's probably right now, that's probably my favorite program. You do have to take a class online, but it usually takes a couple hours. And it's very simple. And it's very informative, so you can learn a lot with that class. And you don't have to be a first-time home buyer, but there are income restrictions that you have to be aware of. So depending on where you're looking to purchase, you would have to meet those guidelines or those restrictions. But it's a really, really good product.
All right, so that basically covered a little bit of what Sarah Williams asked. What are some good programs for first-time home buyers? And there's different programs. DC has DC Opens Doors that provides the down payment, and I think up in Montgomery County has.
So there are a couple, right? So if you're looking, you can see it again. Down payment assistance programs really come down to the specific city. Often there's city programs that exist out there. So depending on where you're looking to purchase, it's going to come down to what they're. Yes, but DC Open Doors, Virginia has the HDA.
I forgot about that.
Maryland Mortgage Program, and they're all really good avenues for you to be able to obtain funds for down payment. But again, you have their limitations and your restrictions, and just want to set the proper expectation that if that's a program you're looking for, we can easily dive into your situation a little bit more and see if it makes sense. Because there are sometimes it does. What I usually tell people is if you don't need the money and you have the money, usually a down payment assistance program may or may not be the best scenario for you. One thing we do have going is we have actually 100% FHA product, which is pretty cool because we go through and we help you with that internal down payment assistance where you have to come up with zero money out of pocket. So that's something that's proprietary to us that we put together with a couple things, and we can dive a little bit more into that possibly next time on that 100% product. But yes, we do. To answer your question, we have ways to help you with down payment, and we have ways to limit how much cash you really need to come with for the transaction.
Got it. All right. Full disclosure, this is my mother-in-law. As a senior citizen living on Social Security and a small salary, would retirement accounts help me qualify?
Yes.
She'd love to buy a house.
So we'll break that down a little bit. So Social Security and pension. So if you're looking into Social Security income, we can absolutely use that. Typically, you want to take a look at your tax returns. And if you're not paying taxes on that income, we can actually mark that up. So we can gross up that income by a certain percentage because you're not being taxed on it. So that allows you to qualify or have a little bit more flexibility with qualifying. Retirement accounts certainly help. Whenever you have more money in the bank, you're less risky, right? Especially depending on if you have full access to that, that can help as well. There are certain programs where you can create income streams off of assets. But again, it's really going to come down to a case-by-case scenario. But yes, to answer your question, the more money on the bank, the less risky you are and the easier it is to qualify. And we can use retirement accounts to qualify, especially depending on age. Many people will, borrow against them. But if you are with retirement age, we can use 100% of that to qualify.
Good to know. All right, let's take a couple more questions and then we'll wrap this up. I said 15 to 20 minutes, and I know you got to get on with your day. Ashley asked, do current loans from investment properties get counted towards the debt in your debt to income ratio?
So that's a really good question. And the answer is yes. Yes and no, depending on what you do. So let's say you own 3 investment properties. And you have all 3 rented out. Depending on the length of you renting those properties out, will determine what income we can use to offset that. So, for example, let's say you've had those properties for 3 years. You report that income on your Schedule E's, on your tax returns, on your federal tax returns, on your 1040. We can use that income to offset the debt associated with that property. So, if you're renting out for more and you're reporting that income, typically we can act as if that debt doesn't even exist because we can use that income to offset that. Now, if you're just purchasing a new investment property, We can usually use rental comparable in the appraisal to offset the new payments. That's a really cool way to be able to qualify for your first investment property. Also, we can use, if you haven't been renting out the property, depending on the loan program, we can usually, typically, if you just sign a lease, you can typically use up to 75% of the gross rental income.
That's what I've heard before. Yeah.
Offset.
Still the case.
Exactly. Yeah. So very conservative set the debt associated with that property so that it allows you to be able to proceed and move forward.
All right. Let's do our last question. And Laura's looking for a property right now, and she also needs a car. So if we need to add a modest loan debt, specifically car loan, how long will that affect the home buying process? Debt to income ratio would still be low.
Yeah. Well, then you can, so as long as if your debt to income ratio is still low, when you're looking at debt to income ratio, we're typically using traditional credit.
Yeah, what are those ratios? I don't remember.
Right. So a couple things. And it's going to come down to loan, right? So conventional financing are going to be more strict on debt to income ratios. Fannie Mae recently allowed us to go to a back end ratio, so including your new mortgage, up to 50%. So there's much flexibility even with conventional financing with your debt to income ratios now. But having a car loan, if you open a new car loan, that is absolutely going to impact your ability to qualify and how much you can qualify for. We look at the payment, so your new mortgage payment, any car loans, student loans, credit cards, any traditional credit you have, and we compare that to your gross monthly income. If that's under 45 to 50%, there's a very good chance you'll be able to qualify for a loan program. Again, that's the really top end. Historically, if you ask a mortgage lender, they'll say 28, 36. Housing ratio of under 20% of your income and total debt to income ratio under 36%. So depending on the loan program, everything's such a case by case scenario. That's why we always recommend reaching out to us.
That's awesome. Thank you for that. And thanks for explaining and joining us today.
Of course. No, thank you for having me. It was a lot of fun.
I put all of our legal requirements in the comments, including your license number and
thank you, sir. I appreciate that.
And all of our everything we're supposed to put down. There's Charlie's telephone number if you want to give him a call if you have any other questions. His email is in the comments below. I'm Mark Rutstein with dcrealestate.com, and we'll do this every Friday going up until the spring market. Next Friday will be David Toa, First Savings or First Home Mortgage. But thanks, Charlie. I appreciate it.
Yeah, absolutely. Thanks for having me.
Have a great day.
Great to help. See you soon.